Just send it. Just send it.
Okay. All right. So I'm gonna read this whole intro, and I'll let you know when we get to the first question. Hi everyone, welcome to a new episode of Research Hour, hosted by Uniswap Labs. Uniswap is the largest marketplace for on-chain digital assets. The tools we create are built on the Uniswap protocol, governed by an independent and decentralized community of Unitoken holders, and today is the largest decentralized trading protocol. Uniswap Labs is focused on building technology that enables users to swap tokens, buy NFTs, provide liquidity, and self-custody their assets with confidence. The opinions expressed during today's conversation will be ours personally and not that of the labs. We have a few guests today. We have Brendan Malone, who works in policy at Paradigm, and Meher Latif, hoping I'm reading that right, and is head of research at the Wormhole Foundation. And Austin is usually my co-host, but today is also our third guest. So Brendan, Meher, and Austin, welcome.
Yes, thank you. It's fun being on the other side for once. I feel like usually I'm the one asking questions, but today I get questions asked to me, which is fun. Um,
Great. First question. Who should read you guys' new piece and why should they care?
oh, so yeah. One of you guys want to talk about that?
I mean, the short answer is everyone. But I think to give maybe a better response, I think we all have pretty unique backgrounds coming from more of a TradFi context. And with the piece, we really tried to contextualize crypto and permissionless blockchains in the historical evolution of financial markets. And so I think there should be something in there for people who are more familiar with crypto and permissionless blockchains and are looking for broader perspective on traditional finance, and also some things in there for people who have more of a traditional background and are curious about what the future might look like.
Yeah, I think something I'd add is that I think a lot of pieces that are written in crypto about TradFi contexts are very either very TradFi, either very crypto-y. I think that one thing that this piece has is a lot of a little bit of both in it. It sort of details pretty with pretty concrete examples of like the benefits that technology has had on finance. And I think like a lot of people somewhat take for granted that like markets have evolved very drastically over time. They're not at all similar as how they used to be. It's not something that people really think about because someone else is sort of paid to think about it for you.
Yeah, I think we come from this traditional financial background, and making this hop, I think it's been surprising for all of us as to how little the two groups know about each other and the respective markets, right? Like on the DeFi side, there are a ton of founders and builders that aren't necessarily aware of the inefficiencies that happen within traditional market structures. That feel so, like, I think obviously solvable with the current tech and applications that we have in crypto, but I think are often sort of overlooked and unknown by the community. I think it's a reasonable thing, just given that since crypto can be such a application agnostic sort of technology, it's hard to sort of hone in on who your specific end user is, which sometimes leads to certain market segments or populations being overlooked. But I think TradFi has actually been one of them, and so yeah, it's certainly for the TradFi base as well as the sort of crypto one as well.
In your article, you wrote, and I quote, "One underlying theme is clear. Financial markets are often reactive, usually hesitating to embrace change or acknowledge its advantages until a crisis catalyzed, etc." absent shocks, gradual adoption of new technology is a long and nonlinear process. We know that the financial markets are in fact notoriously good at predicting success of technological progress, right? In fact, if you look at the value factor, it tends to overperform or outperform, meaning that the financial markets in general assign kind of too much premium to future growth. And so how do we reconcile the fact that maybe it's not the same group of people, or maybe it is the same group of people that are both good and bad in terms of recognizing technological progress and the amount of change that it can bring to productivity and whatever you call it that eventually leads to its current price?
Yeah, I think, just to take that initial stab, I think the unfortunate reality, right, is that with financial markets, and I think a lot of the issues that they're dealing with is that the tech stack is only one part of the package sort of solution. It also requires belief in the tech by the stakeholders, otherwise known as like community, and also like legal and regulatory headway to be made, right? And so I think that's one of the reasons why these solutions take a long time to sort of get ground and actually get traction. There's that saying that like days happen in years and then years happen in days. And I think that's the sort of thinking there. There's a sort of unique catalyst that sort of creates this sort of belief in the actual technology, but it takes time for that to happen. Yeah.
Yeah, I think one thing is like you've seen this in history as well, with sort of like early internet stocks going up a lot and a lot of belief and a lot of value flowing into early internet stocks. But then the central limit order book that was sort of built on internet, the new sort of internet, was not like implemented until like 2006 or 7. So there's sort of this disconnect between like what TradFi and what people are investing and putting value into versus like what the actual markets are running on. And we sort of have this sort of region where we're trying to incorporate some of this technology. So like we had RFQ over the internet for a while, but it's sort of just like not something. It's sort of like the previous sort of way that we did trading with a little bit of the new technology tacked onto it instead of a tacked on sort of a solution that comes from the ground up, thought from first principles with that technology.
And I think like the market dynamics reinforce that behavior. So at least on the infrastructure side, financial market infrastructures tend to be a game that tend towards natural monopolies. So there's a pretty high upfront capex required to create things like exchanges and central securities depositories. Once you have them in place, the marginal cost of like offering the service to another user is relatively little, and so you get these moats and network effects around infrastructures, which do not create great incentives for them to adopt new technologies because they're in some ways insulated from competitive pressures. So in the long run, I think because competitive pressure is not typically the like normal market dynamic that would force them to change and adopt new technologies, we see in practice a lot more technical change coming in almost like a stepwise fashion in response to like major events or crises.
I guess I'll sort of ask a question to myself and the other two, but I think one of the things, it would be sort of interesting to talk about some of those crises and how they catalyze this change, because I think that like people don't think about them that much and aren't as aware of them, but they're actually quite interesting and quite it's quite cool to see the stepwise function happen in real time.
Yeah, I think that was a fun sort of experiment for us when we were writing this piece, to kind of play financial historian for a bit and look at the sort of history of market evolution. I think we were all surprised at how these changes were sort of catalyzed. Right, in the piece that we mentioned, like there was a paperwork crisis, and then the idea that the buying and selling of a stock back in the 1960s required literally the physical transfer of a paper certificate, exchanging hands between the seller, the broker, the transfer agent, the buyer, with 60 different steps. In the meantime, like in retrospect, it's no surprise that model didn't work. And so when you had a huge surge in volume, none of these processes could keep up. And there was that sort of like famous Lehman Brothers quote where I think they had like 450 million securities whose owner they couldn't find, and then $200 million dollars worth of securities who it owed to clients, but had no idea whose clients it owed it to. So it's this sort of like incredibly like complex system that arises, and it's no surprise in retrospect that it happened. And we didn't include this in the piece, but there was also the mob sort of taking a chunk of some of the dollars. I think there was some paper by, I think this guy is called Matt Yeager, and he estimated that I think $100 million worth of securities had been stolen by this sort of New York Italian mob back in the 60s and 70s. And so once you had this sort of paperwork crisis where this surge of volume hit, you have mounds and mounds of paperwork, and broker dealers trying to sort of keep up with their clients' requests. Inevitably, something has to change once everything breaks. And I think you see that a lot today. I mean, even the most recent sort of electronification of equities trading. We had this sort of computer revolution in the 90s and early 2000s, and yet there was a reluctance to move from the open pits to computerized trading. I mean, there was the CEO of Life, which later became ICE. I think it's one of the larger London exchanges. Stated in I think 1998 that no computerized trading platform would ever beat the liquidity provided by the open pits, which obviously in retrospect is such a wrong sort of perspective, and yet that was this sort of belief held by the incumbents. So there is this general reluctance, and I think Brendan has a few more as well. There's just so much with respect to these sort of catalysts that always kind of bring out interesting innovations.
Yeah, one of the things that is fascinating to me is just how the changes in technology and market structure that we've seen in the past are provoked by problems that we like see today in crypto. And architecturally and linguistically, there are mirror images in certain places. So another example that I find quite amusing is there are two large central securities depositories in Europe, Euroclear and Clearstream. They used to be both located in Luxembourg, and they were across a valley from one another. And there were problems in Europe in general in security settlement because you had two liquidity pools associated with the securities for each of these CSDs that didn't function as one set of assets. And there's actually a physical bridge that went across the valley that was used to settle transactions between them. Today, they have an electronic bridge between them, and they literally call it a bridge between the two CSDs that they use to settle transactions. So you can be a user of one of the CSDs and access the liquidity pool of the other one without necessarily being a user there. And of course, everyone who works in crypto is familiar with this concept of bridges and the need to have some way to connect potentially fragmented pools of liquidity in different places. So all throughout history and all throughout different market structures and different asset classes, some of the same problems keep cropping up. And architecturally, we're kind of zeroing in on different ways to fix them here and there.
This is kind of interesting because I think, as Brendan, you've mentioned, financial markets tend to sort of gravitate towards natural monopolies in some cases. I think even within crypto, we're seeing some of it, right? In the builder market, we're seeing the top, few builders building 95% of number of slots and so on. What do you think will be sort of the technology stack that they hold on to. What would be a time when these rational profit-seeking entities will be the ones not the first to adopt like new technology that would give me or give them even more advantage over each other, but rather be the guys that are kind of stopping new technologies from getting wide adoption.
Yeah, I think this is the big question. If you look at what some of the traditional actors like DTCC, Euroclear, et cetera, have done recently, like they're putting out papers that talk about tokenization. And from the back end perspective, DTCC could tokenize all of the equities at the NSCC relatively easily from a technical perspective, and probably even from the perspective of just legal guarantees that they could build up around those. If they were to do that, would anyone be able to compete or enter that market and try to challenge them? And I think that's a big question that I certainly don't know the answer to, but in some ways, I think the ability of public permissionless blockchains to provide a substrate that is accessible across different infrastructures and has like the characteristics of an open technology platform makes it more difficult to assert these moats and proprietary business models around what was previously easier to police from an access and technology perspective.
Yeah, I think one of the things that's interesting to think about is also like what is crypto holding on today that like people in crypto are also holding on to things that might not be the most efficient. And so like what are things that crypto people are holding on to that in the near future will be different? I don't really know if it's a question that like we can all answer, but it's definitely something that like when I'm thinking about a piece or thinking about the future of crypto, I'm trying to think about like what currently do people just love that is not perfect and probably will change on the short run. And I think like one thing that comes to mind is like EOAs, like end user accounts are sort of probably not the most efficient thing for people to own. And so like when we see this increase of smart accounts and smart wallets like MPC, it'll be sort of interesting like to see how long people hold on to their EOAs, even though it might not be like perfectly rational. If because like there's no one's perfectly rational, right? And so it's interesting to see like how long people hold on to them.
Are the benefits of stablecoins or the alleged benefits of stablecoins coming from regulatory arbitrage? I know that Austin and myself have alleged a lot of those, but if you think hard about it, FedNow offers some kind of instant payment among institutions. FX spot markets are extremely tight, and to the point that the dealer desks are cross-subsidizing them with their other desks just to keep the client relationship. Why can't these banks just solve the FX cross-border remittance problem already? What's stopping them?
Yeah, I have sort of an interesting thought about this. People always sort of bring up, and I know you're also aware of this shit. I know you're sort of playing devil's advocate to some extent. Is that the FX dealers have extremely good liquidity and have really good spreads, but FX end users really don't. So I was in the Netherlands and I went to this, like, people were talking about how this is the best place to get cash, and they had a 10% spread. And everyone's like, wow, that's so great. And I was like, this is like really not great at all, right? Like if you had a 10% spread in a TradFi market, it would be kind of insane. And so it's sort of like the benefits of stable coins are this ability to sort of like trickle down to users. Users who trade FX on Uniswap, for example, get almost as good of trades as a TradFi user gets. And even I sort of went and I looked at like an ATM and I was like, what rate are you getting on this ATM? And then I opened up my Uniswap interface and I was like, these rates are like very comparable. And it was sort of pretty interesting to me that like that is sort of FX on AMMs is somewhat of a nascent market and it's pretty new. There's not like a lot of interdealer play, but like it still has like almost TradFi levels prices, and that's sort of just like one of the nice parts about AMMs is sort of this benefit of bootstrapping liquidity on these new chains. I don't know if you guys have anything else to say about it.
And what do you think sort of a future would look like when we move towards more regulation and more compliance? I've heard things like centralized exchanges now require some sort of KYC before they can transfer crypto. You have delay in settlement and so on. Do you think we'll just converge to sort of the pre-crypto TradFi equilibrium, or what's there to be gained once we take out this sort of differential in the amount of regulation we have?
I mean, I think the optimal like amount of intermediation is probably not zero for everybody, and I think like to the extent that the crypto ecosystem touches traditional finance and people still need on and off ramps, like on the margins in certain places, it'll probably look relatively similar. I mean, that said, like the ability to have a self-hosted wallet and interact with a DeFi protocol without using a regulated provider like an exchange is, something that I don't know that will lose the ability to do it, at least not on a global level.
Have you guys been following this new BIS AMM pilot? Any thoughts on that? Project Mariana, I think.
Yeah, we're cited in it. It's a sort of a self shill that we get to do. But yeah, I think Project Mariana is very cool. Using AMMs to do cross-border central bank digital currency swaps. I think it sort of speaks to I would say that the piece is very, very. I wouldn't say it's not pro crypto, obviously, but it spoke about a lot of the benefits that we see, and it talked about a lot of the issues that are still existing in crypto that we still agree with to some extent. And I think that I think that like Project Mariana is very interesting, that like central banks who are usually like people who very much dislike are seen as people who don't like crypto are actively exploring it. You guys have thoughts? I sent this to you like 2 hours ago, so I highly doubt you read it. But yeah, I read it this morning. And I was like, gotta send it to the boys.
But if anything, it's I guess like a validation of the thesis that we have, right? Which is that it takes time for these sort of large banking institutions and sort of research bodies to slowly first like come around to the awareness of the technology and then potentially the adoption itself, right? So Project Mariana and a bunch of others I think are like the right step forward for sure.
Yeah, like central banks are not typically inventors of radically new technology, but it's cool to see the adoption flywheel play out where they are going to protocols that are publicly battle tested, trying to port those into their own environments to address specific problems that they face, but they're doing it with the right guardrails that make sense for their own context. And I think they recognize that to the extent that they come down too aggressively on crypto, generally on DeFi in particular, they'll lose the ability to do this in the future. I don't think that like the BIS or anyone else has delusions that like they're going to be the ones deploying new and novel mechanisms to mainnet like anytime soon. And so just having the validation that they see something useful in the technology and they're willing to go where the market is and where the innovation is, and do so like not 3 to 4 decades like post innovation, but just a couple of years afterwards is pretty exciting.
Yeah, I think like one thing I thought was interesting from the paper was that they actually did this on Sepolia, on Ethereum Sepolia. So it was actually on a what people would consider sort of a public blockchain.
So speaking of central banks, Brandon, how has the stance of the Fed changed or evolved since your 2016 report, Distributed Ledger Technology in Payments, Clearing, and Settlement? And how much do you agree with the evolvement?
Yeah, I think I mean that was like an interesting report to be a part of in general. So I joined the board in January 2016, and at that point in time, there wasn't a dedicated team looking at crypto. There was just really a coalition of the willing, a group of volunteers, people like myself who'd kind of previously discovered crypto and were interested in it, also interested in finance, and self-motivated enough to like work on those topics together in just a like very small percentage of our time. We ended up interviewing like 30 or so companies that were working in the space. The hot thing of the day was enterprise blockchain. So there were like a lot of companies like R3, Digital Asset Holdings, that were trying to do the blockchain, not Bitcoin thing. And I think at that point in time, like there was a lot of enthusiasm around the purely permissioned blockchain world, which kind of turned out to not bear a lot of fruit. From there, things went very quickly to central bank digital currencies and then stable coins. And there was a big shift in approach and overall tone when Facebook announced the Libra project, or DM project, I think is the first iteration was. And then it like kind of became more of a polarizing topic, and engagement around the world spiked a little bit. And I think the Fed now is still quite engaged in doing more hands-on experimentation itself. But given that it is fundamentally different in a global sense from a lot of the central banks that are working on projects like Project Mariana, they're not really able to do the same sorts of projects, and it would probably not be good for the global monetary system if the Fed was the first mover in some of these places.
Question for Maher. Having been involved in several attempts to help refugees in the past, including building an app for them, what have you learned that impacts your thinking on crypto's potential to serve population with less resources and less technology readily available?
Yeah, I think that's an interesting question. I think so. My family comes from the Middle East, and in the Middle East, there is no sort of democracy that exists, and as a consequence, it creates a lot of instability for the economies. It creates a lot of instability for the people in terms of just the fabric of society as well, and it's unfortunately led to a lot of poor economic outcomes. I've had family and friends who have lost their entire life savings just by virtue of the fact that they live in Lebanon and they're dealing with an economy with super high hyperinflation. And I think while the crypto community now, I think maybe over the past 6 months or so, is beginning to preach the benefits of this tech within that sort of context of these underserved populations, for a long period of time, I think it felt very much overlooked from a narrative perspective. Yet, as a matter of fact, I'm sure the largest majority in use of stablecoin holders outside of the US are probably concentrated within these sort of fragile emerging market economies. So for me, I think it's really stemmed the belief that it is a fundamental economic right that an individual has the ability to hold value in a currency that is exogenous to their own economy and country's political and economic volatility. That is the fundamental economic right. And while it has certain sort of second order and third order implications with respect to the actual country's stability of its currency, I think you have to kind of examine it within a sort of comparative lens. The most wealthy and privileged segments of that country have that ability now. A lot of them have accounts in Switzerland and in the U.S. via family members or themselves because of this dual citizenship, and as a consequence, have that privilege of having stable access to savings while still living in that country. But it's the unfortunate reality that people within the sort of lower income tier segments of that society don't have that same privilege. And I think what is so exciting about crypto is that it democratizes that access across all segments of the society, which I think is important. It's a sad reality. It's a sad reality that you have the politicians and the political ruling class within these countries that make these decisions, and yet are the most immune from their consequences. So for me, I think that has been the most sort of exciting and driving component with respect to the power of the technology in an emerging market context.
What do you think will be the most cost-effective social policy initiative from a U.S. point of view? Obviously, not asking you to make policies right now, but it does feel like, right now, if you look at what tax stack is being used, right? People are in general using USDT plus Tron plus Binance. Like, do we think we have a better solution? And if so, what is the sort of policy delta that we're looking for so that we're not maybe at a disadvantage when competing in an international environment?
Yeah, I think it's a question that depends on what the sort of outcome you're sort of working towards. If we want better sort of market regulation within the US, then there's a whole set of policies that we can think about, and there are a whole set of market events and previous examples of manipulation that we can use as sort of historical catalyst to say, hey, this is the right direction in terms of how this sort of market should move forward. With respect to like emerging markets and stable coins, I think the US's specific role, there's a lot of, I think, additional transparency with respect to stablecoin regulation that I think would be beneficial, certainly to allow the more transparent and compliant stablecoins better compete with the ones that are existing today. And I think that is certainly a big advantage. We want to at least provide those within the emerging markets optionality with respect to what stablecoin they want to put their savings in, and a lot of transparency with respect to the different mechanisms around reporting and around the actual legal structure in which the assets are held. And that avoids a lot of the sort of catastrophe that we've seen historically with individuals who are desperate enough to put their money in any sort of asset that isn't their local currency, right? And sometimes they put it in something that's volatile. Sometimes they put it in something that has a sort of poor sort of mechanism for stabilization, and they get hurt. So I think expanding that optionality through regulatory clarity is probably one of the best things that we could do. And then also enabling the stablecoins themselves to have better mechanisms with respect to holding assets, right? I think banking counterparty risk right now is obviously a big thing post Silicon Valley Bank. And as a consequence, what are the right mechanisms that we can enable for a stablecoin like USDC issued by Circle, whereby they don't have to worry too much about counterparty risk for some of their more liquid assets, namely cash, right? If we could have some sort of network of matchbook repo settlement, whereby your cash doesn't have counterparty risk, it's earning yield, then that meets a lot of the sort of advantages that we would want in a sort of bank deposit system that actually doesn't require banks. So I think that sort of stuff is certainly exciting from a US legal and regulatory perspective.
And I think like also kind of consistent with current public policy priorities. So approximately, I think like 50% of physical banknotes, US dollar cash, is held offshore. And about 80% of that is in the form of $100 bills. And the Fed's like policy is to flexibly or elastically supply cash. There's no like limit on the amount of cash that you can have. It's just kind of purely done by demand based on the amount of money in the financial system. So there's already like a longstanding priority to like make cash available offshore for people to use. And I think a logical step from there is like make it available to use in digital form, which is a nice way to kind of extend US soft power in other places and give people access to a payment instrument and a store of value that may be more stable and easier to use than some of their local currencies.
So while we're on the topic of stablecoins, Austin, you've done research on algo stablecoins at the Fed, and congrats on finally getting your paper published after the Terra Luna incident. What was your conclusion, and is algo stablecoin dead right now?
Yeah, I think that there's sort of there's sort of two different types of algo stablecoins that we can sort of look at. I think there's sort of the over-collateralized version like DAI or LUSD that are over-collateralized, essentially just are functionally just on-chain institutions that change, that sort of like give stability with unstable instruments. And there's also under-collateralized stablecoins that were like Iron and Titan, and then followed up with like Terra and Luna that I don't think can fundamentally work without a lot of value accrual to the underlying equity stake that backs the currency. The problem with, I guess, Iron and Titan was that the whole value of Titan, which was the equity stake in this algo stablecoin, was all it was just all like the fact that it was being used in the system. So when the system went down, the value went down, which made the system go down even more, and it had this sort of self death spiral property. And then I wrote that piece about Iron and Titan because generally bank runs don't have very good data. Banks, they're not publishing all of the reserves and all the deposits and withdrawals and like mark to market, like minutely capital that they own. But this sort of stablecoin run, it is sort of publishing all the value that is owned and who owns it each time. And so it was very interesting to sort of see like a bank run in real time through data that was high frequency. And yeah, I think like under collateralized stablecoins, I don't really think can work because they have this sort of death spiral property that once it starts, it's impossible to stop. And I finished that paper about a year before Terra Luna happened, but it was not. It was going through the review process, and so it didn't come out until after it. But I felt very cool. I was like, I predicted this. And it was very cool to sort of see that come out in real time when Terra and Luna sort of just like went to zero.
What do you think, like collateral quality aside, what are the benefits of just having on-chain collateral by itself from an operational perspective? You see a lot of the stable coins today, they're like a bolted on appendage that's attached to the treasury market and banking system. And you have this mismatch where on one side you have these very old rails, markets that don't operate 24/7, systems that have broken down, especially in times of crisis. But then on the other side, you have on-chain stable coins that are circulating 24/7 can be minted and redeemed pretty much whenever. You think there's like a way to reconcile those two things and build better stable coins by first building better systems for other assets like treasuries and those that you might use for collateral?
Yeah, that was a good question. I think that uh, this is something that like Dai thinks about a lot. Dai or I think it was Psi, like the single collateral Dai used to just be ETH, and it sort of hit a point where they owned so much of the ETH that was free floating that it was sort of problematic for them to onboard more capital. And that was really early on, right? That was like 2020, and they made the decision to open up to more collateral types, and then one of which became USDC, or one of which was USDC, and then that sort of bolted on this TradFi system. And I think they did that as sort of a desire to expand the system and experiment and gain more yield. But I think that like they're sort of just using this as an experimentation phase, right? And seeing how does it work, and can we reasonably do both by like essentially bolting on these TradFi systems, but still getting the benefit of them. And I think that like an purely on-chain stablecoin can work. I think one of the issues with on-chain markets currently is that there's a very like they're very complicated. There's a lot of like counterparty risk. There's a lot of like counterparty risk through smart contract risk, and there's not a ton of like high quality yield sources. And so I think people are. It's just sort of easier to go buy a treasury bill and then just be like, this is fine. But I think that like as more sophisticated on-chain markets grow and as more desire for on-chain markets and more markets evolve, there will be just entirely on-chain stable coins, which has a lot of great benefits with like knowing exactly what your balance sheet looks like at any time. As we sort of saw with some stable coins, there's been some issues with like their balance sheet isn't fully public. You don't really know how much are they collateralized. But with sort of on-chain stable coins, you always know what your sort of collateral is.
Yeah, I think to add on to that, I think tokenization has gotten a lot of excitement and is like one of these sort of emerging narratives with respect to the DeFi and in our space in general. But I think Austin's right. The way that we think about tokenization now, I think, is a very two-dimensional view. In that, the sort of tokenized treasuries that we have right now, it's a special purpose vehicle. There is some sort of counterparty risk. There is execution risk as well. If we can evolve to a sort of natively issued security that is natively on the blockchain, as opposed to sort of purchased in the traditional financial market and then just simply tokenized, then you sort of meet the same sort of requirements of the actual stablecoin itself, right? Redemptions can happen in the same sort of 24/7 time window. You have sort of better transparency with respect to collateral itself, and that obviously extends to crypto native collateral like ETH, but also traditional financial market forms of collateral if they are natively issued. And so I think there are a number of teams that are thinking about on-chain rated instruments that are natively issued as opposed to just simply tokenized from their special purpose vehicle purchasing entities.
Last question. What are you guys been working on? What are you feeling most excited about currently?
Yeah, I think we sort of want to write another piece about tech and finance with a lot of the themes that have come up in this call around verifiable ownership and a lot of the benefits that TradFi people would like and that are publicly accessible, but not really sort of like written about deeply in sort of like crypto literature. I think that's like one of the things that I'm, I guess, personally working on with the other two. So I let them, but I want them to shill the things they're personally working on, you know, so they have a little bit of time for that.
Yeah, I'm happy to go next. We just announced this week the launch of a new project called the Paradigm Policy Lab. So this is a one-stop shop for the regular legal research, policy research that we've always done, plus a few new programs. We just launched an academic fellowship, which is going to feature in the first iteration a lawyer from Harvard's Berkman Klein Center, Primavera De Filippi, along with an economist and operations research scientist from Columbia, Agostina Caponi. They're both going to look at comparative dynamics between systems that are bounded by law and regulation and systems that are bounded by technology. So they're going to look at the conditions under which they can produce similar outcomes. The other program we announced was a more of an open source bug bounty style program, but targeting policy relevant questions. So our feeling has been that there's a lot of latent energy and expertise in crypto in general. You have pretty vibrant ecosystem of Dune wizards and people like Zach XBT who are doing quite rigorous forensic analysis, like on-chain events. And we're trying to be a clearinghouse between people with those skills and policymakers who are asking questions about crypto, but maybe don't have the same awareness and on-chain context to get those answers. So we're posting more discrete questions there, asking people to try to answer them and giving away cash prizes and also clout kind of associated with being able to clear a number of these bounties.
Yeah, I think that's super exciting. Mine, I unfortunately can't probably share too much. There's a ton of sort of products that, you know, the Wormhole protocol and its set of contributors are going to be rolling out over the next few weeks. I will say that the team is incessantly focused on enabling the sort of best developer experience for cross-chain messages. And then on top of that, thinking creatively about, you know, in what form can these messages take, right? You know, I think oftentimes when people think about anything cross-chain, they think about cross-chain governance. You know, Uniswap, I think, comes to mind. Certainly Wormhole comes to mind there as well. But they also think about, you know, cross-chain token transfers. I think outside of those two realms, there's actually a lot of interesting ways to utilize native cross-chain messaging for protocols that kind of enable multi-dimensional functionalities for, you know, any sort of DeFi protocol, be it a perp, a DEX, or anything of that sort. So more on that to come. I think that's something that's certainly really, really exciting for us. And I think also more importantly, there's some new developments with respect to the ZK roadmap that Wormhole will be working on, just generally sort of improving its trust assumptions and making it one of the sort of most trustless bridges in the space. So that for us is I think really exciting. But yeah.
This has been great. Brandon, Maher, and Austin, thank you guys very much for coming. And we'll see you hopefully next time.
Yep. All right. It was a nice chatting.